What is DTI, also known as debt to income in the mortgage world? Well, how do we calculate it? So debt to income is the client's ability to manage monthly payments and repay their debts. And this is calculated on a monthly basis. So we take the client's gross monthly income and multiply it by the loan program's guideline. Now, the standard mortgage debt to income ratio most lenders use is at 45%. But please understand, most programs have their own requirements for debt to income. Some will go higher than 45 and some do require a lower debt to income ratio than 45. So every program is going to be different. So for this purpose, we are going to use the kind of standard in the industry at 45%. So what we do then is we're going to take all recurring monthly debts such as credit cards, student loans, auto payments, child support, alimony, IRS debt, any monthly obligation debts that require payment, and we break it down. So let's say our client has $8,000 gross salary and we're going to use the 45% debt to income ratio. So we are going to take $8,000 and multiply that by 0.45, which is then going to give us $3,600. So let's look and say, okay, we've reviewed credit report and any outstanding other debt that is reoccurring that we do have to include into the ratio, and we come up with $850 is what the whole client obligation is for their monthly obligations outside of mortgage or rent. So when I take that $3,600, I am now going to subtract $850, which is going to drop me down to $2,750 for a monthly mortgage buying power. So that is our client's buying power. So we would then go in and look at down payment. We would look at, is there mortgage insurance, all other options to find out what sales price we land at to get to that $2,750. So a lot of cases with my clients, I will work backwards, because if somebody has higher insurance, homeowners insurance or flood insurance or HOAs, there's so many factors that could come into this total payment of $2,750, and we have to look at that total payment. So if I take $2,750 and let's just say it's a standard 5% down conventional loan, that our client is going to be looking at a $380,000 sales price with 5% down, and that's going to include taxes, insurance, and mortgage insurances, and should come in pretty close to that $2,750 mark. So that is how debt to income is calculated.